What is private equity? Private equity refers to an investment in a privately held business by accredited investors, a private equity firm, or institutional investors, with the hopes that they can grow the business, improve operational efficiencies, and add strategic value to that company. A private equity investment is one that is typically held for a term of maybe 5 to 10 years. After those 5 to 10 years are up, they've hoped that they've added extreme value to that business, and they can now have an exit or a liquidity event and return that money to the investors. So, how exactly does a private equity firm operate? So, what a private equity firm will do is they will raise money from accredited investors, and then they will look at privately held businesses that they can take a control ownership in. They will look to decrease costs, improve margins of the business, look for new customers, and help to scale and grow that business. Private equity can oftentimes lead to higher returns. However, this money that you have invested in private equity would be a lot less liquid. For example, you might have your money tied up into a business for 7 to 10 years before you have an exit or a liquidity event. So, a private equity firm has the hopes of generating exceptional returns above and beyond what the publicly traded stock market can do. Also, for some investors, it's a way to diversify what they're currently invested in, whether that be S&P 500 stocks or fixed income or municipal bonds. This it's also hopes that you can generate a higher return by having private equity within your investment portfolio. So again, a private equity investment is any investment in a privately held business with the hopes of growing the business, improving operations, adding strategic value to that business to later on down the road exceed exponential returns by selling that business to a larger strategic buyer.